Today is Saturday, February 21st, 2026, and silver just crossed $84 per ounce. Let me say that again, $84 per ounce, up from $78 just 72 hours ago. Now here's the impossible contradiction I need you to sit with before we go any further. COMEX, the world's largest silver exchange, officially says there are 98 million ounces of registered silver available for delivery right now. 98 million ounces. On paper, supply exists. On paper, everything is fine. But in the last 24 hours alone, dealers from London to Sydney to New York have posted out-of-stock notices on their physical silver pages. Major bullion distributors are quoting 4 to 6 week lead times, and one of the largest online dealers in the United States sold out of 1,000-ounce silver bars completely, in a single day. So you tell me, if there are 98 million ounces sitting in a vault somewhere, where did the physical silver go? By the end of this video, you will understand exactly what is happening and exactly what to do. Because what we are watching right now is not just a geopolitical panic. It is the moment where the paper lie about silver supply is colliding head-on with the physical truth. And once that collision happens at full speed, nothing will ever be the same. Let's start with the hard numbers from this week. On Wednesday, February 18th, U.S. National Security advisors met in the White House Situation Room to discuss a potential strike on Iran. Sources confirmed that all U.S. military forces deployed to the region should be in place by mid-March. Vice President J.D. Vance publicly stated that Iran failed to meet U.S. red lines. President Trump repeated that military action remains an option. Within hours of that meeting becoming public, silver jumped 5.2% in a single session, from $75.40 to $79.20. Let me show you what happened next. Thursday, $80.20. Friday close, $82.70. By Saturday pre-market, touching $84. That's an $8.60 move in 72 hours, on a metal supposedly controlled by the paper futures market. Now let me introduce you to the institution that sits at the center of all of this, CME Group, the owner of COMEX, the casino where silver is priced every single day. Right now, the March 2026 futures contract on COMEX represents 105,000 contracts. Each contract covers 5,000 ounces. Do the math with me. 105,000 times 5,000 equals 525 million ounces of silver exposure, against 98 million ounces of registered physical silver. That is more than 5 times the deliverable supply in one contract month. Think of it like a theater with 525 seats sold for a building with 98 seats. Nobody panics when the show is 10 months away, but when someone yells fire, when a U.S. strike on Iran becomes real, everybody runs for the exit at once, and there aren't enough seats. CME's mechanism is simple. They create paper contracts from thin air. They sell silver that does not physically exist. As long as everyone takes cash settlement, the game continues. The moment people demand physical delivery, actual bars, actual coins, actual metal, the math breaks down completely. Between January 7th and January 14th of this year, just 7 days, 33.45 million ounces were physically withdrawn from COMEX for delivery. 26% of the entire registered inventory, gone, in 1 week. The month before an Iran crisis even started. But here's what they don't want you to see. This is not a rumor from a blog. The evidence is coming from 4 continents simultaneously. It started in New York. COMEX's own official depository statistics, dated February 11th, 2026, confirmed a single-day withdrawal of 3,256,882 ounces from the registered category, in 1 day. That pushed registered silver below 100 million ounces for the first time in years, to 98,138,005. The same day, an additional 4.7 million ounces were pulled from the eligible category. That's a combined net withdrawal of nearly 8 million ounces in 24 hours, from one exchange, on a Thursday. Move to London. The LBMA, the London Bullion Market Association, the beating heart of global silver trading, has seen inventories collapse to historic lows. Borrowing costs for physical silver in the London lease market spiked to 200% annualized during the most acute tightness this year. Let me explain what that means. Dealers who needed to borrow silver to fulfill delivery obligations were paying 200% annual interest to get their hands on real metal. That is not a functioning market. That is a market in crisis, trying to hide the crisis with a paper rate. Move to Shanghai. This is where it gets truly alarming. The Shanghai Gold Exchange, China's official physical metals marketplace, has been trading silver at a 12 to 13% premium above the COMEX futures price. In real numbers, when COMEX paper says silver is worth $78, Shanghai Physical is pricing it at $87 to $88. Analysts at Bullion Star confirmed this is among the most extreme price divergences observed in the modern silver market. China's government designated silver as a strategic asset, imposed export restrictions effective January 1st, and has not reversed them. China is not selling its silver to the world. China is keeping it. Move to India. On Friday, February 20th, yesterday, the multi-commodity exchange in Mumbai recorded silver contracts for March delivery at 2,045,750 rupees per kilogram, up 1.8% in a single session. Jigar Trivedi, senior research analyst at IndusInd Securities, noted that Trump set a 10 to 15-day deadline for nuclear deal talks with Iran, while simultaneously deploying the largest U.S. military force in the Middle East since the 2003 Iraq invasion. India's physical silver premiums are running elevated. India does not buy paper. India buys metal. Always has. And now the kicker. Costco. Yes, that Costco, the American wholesale retailer. Costco's online silver coin listings went to zero inventory within hours of the Wednesday Iran news drop. Retail silver buyers, not hedge funds, not institutions, ordinary families who shop for paper towels and then pick up a tube of silver coins at checkout, cleared the shelves. When Costco runs out of silver, you know demand has jumped the fence from the financial system into the real world. Ola Hansen, head of commodity strategy at Saxo Bank, one of the most respected voices in this space, said it directly this week, quote, "The precious metals sector has so far been the primary beneficiary of heightened U.S. attack concerns. This is not one country having a bad day. This is a global systemic crisis. 5 continents, official exchanges, government mints, wholesale retailers, all telling the same story. Physical silver is disappearing. But who is doing this? And why?" Here is the pattern you need to burn into your memory. Pay attention to when the price suppression happens. Every single day, silver gets hammered between 8 a.m. and 10:30 a.m. New York time. That is the COMEX open. That is when the paper contracts come flooding in. That is when banks and algorithmic traders press a button and create synthetic supply from absolutely nothing. It happens like clockwork. You can chart it, you can time it, you can almost set your watch by it. Now compare that to what happens in Asian hours. Side A, West, the banks. JP Morgan, a name you need to remember, issued 99% of the 8.1 million ounces of delivery notices on COMEX in early January. 99%, through 1,624 contracts. JP Morgan is simultaneously one of the largest paper silver short sellers and one of the largest physical silver holders in the world. They are playing both sides of the poker table while running the casino. They sell paper silver in the morning to depress prices. Then they buy physical silver at suppressed prices through their custodial vaults. It is not illegal. It is the game. Side B, East, the buyers. While JP Morgan presses sell on a keyboard in Manhattan, China is loading silver onto trains and moving it into government strategic reserves. India imported a record volume of silver in 2025. The Shanghai Exchange is paying 13% over COMEX spot because buyers there refuse to take paper. They want bars, they want coins, they want weight. In Dubai, physical silver premiums have been running at $3 to $5 above Western benchmarks for months straight. Sprott Physical Silver Trust, run by some of the most respected names in the hard asset space, just doubled their capital raise program to $2 billion, specifically to buy physical silver from the open market. $2 billion. One side is playing a video game, the other side is taking home the prize. At current silver prices, around $84 per ounce, that $2 billion Sprott raise could acquire roughly 23 million ounces of physical silver. That is nearly 23% of COMEX's entire registered inventory, pulled into private, allocated storage, away from the paper game, forever. Which side knows what silver is really worth? We've been here before. Not exactly, but close enough that the pattern should make your hair stand up. Cast your mind back to 1979 and 1980. The world was watching the Iranian hostage crisis. U.S. forces had failed a rescue mission. The Cold War was escalating. Inflation was running at 13%, and silver, sitting at roughly $6 per ounce in early 1979, moved to $49.45 by January 21, 1980. That is a 724% move in approximately 13 months. Now, I am not saying we are about to see $84 silver become $600 silver. I am not saying the Hunt brothers scenario repeats exactly. but listen carefully to the fundamental dynamic, because it is identical. In 1979, you had geopolitical crisis in the Middle East, a U.S. military posture of escalation, physical metal being drained from exchanges faster than paper could cover, and retail investors who had never owned silver in their lives suddenly scrambling to find physical supply that wasn't there. Today you have geopolitical crisis in the Middle East, U.S. military forces deployed to the region on a mid-March timeline, COMEX registered inventory down 75% from its 2020 peak of 346 million ounces to 98 million ounces, and, as of yesterday, Costco sold out of silver coins in less than 24 hours. The Silver Institute, one of the most conservative voices in the industry, has projected the 2025 silver supply deficit at 295 million ounces, the deepest on record. The cumulative global silver deficit since 2019 now stands above 1.3 billion ounces. That is not a rounding error. That is a structural black hole that no amount of paper contracts can fill. I am not saying this will repeat exactly, but the fundamental dynamic is identical. The question is not if, the question is when. Let me give you the summary fast. In the last 72 hours, silver moved from $78 to $84 on U.S.-Iran strike fears. COMEX registered inventory already sits below 100 million ounces, while 525 million ounces of paper exposure sits on top of it. Shanghai is paying 13% over Western spot for real metal. China has banned silver exports. COMEX saw 33.45 million ounces physically withdrawn in a single week in January. JP Morgan issued 99% of delivery notices on the exchange in the same period. The global silver deficit since 2019 is over 1.3 billion ounces, and Costco sold out of silver in a day. Now, there are three types of people watching this video right now. Type 1, scared. They see $84 silver and panic. They think they missed the move. They sell their physical stack at the first dip, take a small profit, and get out. 6 months from now, they will watch silver from the sidelines and say, I knew it. They didn't act, they reacted. That is not the same thing. Type 2, confused. They understand something big is happening. They've watched 10 videos this week. They have 17 browser tabs open. They can't decide whether to buy, sell, or wait. So they do nothing. And the move happens without them. The frozen investor never wins in a supply crisis. Type 3, understands. They see $84 silver not as a price to fear, but as a data point in a much larger picture. They are not trading silver, they are holding it. They understand the impossible contradiction at the center of this market, and they know exactly what it means. Which type are you? Here is what each type should do right now. If you are holding physical silver, do not sell into this fear spike. The move we are seeing is not driven by speculation. It's driven by structural supply collapse plus geopolitical acceleration. The Iran situation has not resolved. U.S. forces reach position by mid-March. Hold. If you are holding paper silver, ETFs, futures, SLV, ask yourself one question. In a delivery failure scenario, does your paper position give you actual metal, or does it give you cash settlement at whatever price the exchange decides? Know what you own before you need to know. If you are looking to buy, premium matters now. The paper price says $84. Physical dealers are quoting $87 to $92 with 4 to 6 week lead times. Buy from reputable dealers, expect to pay a premium, and understand that the premium itself is telling you the real story about supply. Now remember where we started today. COMEX officially says 98 million ounces of silver exist for delivery. But in the last 24 hours alone, dealers from London to Sydney to New York have posted out-of-stock notices on physical silver. If there are 98 million ounces sitting in a vault somewhere, where did the physical silver go? You know the answer now. I hope you'll do something with it.